Okay, so in this video, I wanted to cover the question, what happens when a U.S. person opens a foreign corporate entity? What taxes in the U.S., if any, does the foreign corporation pay? What tax filings does it need to do? And then what are the issues for this shareholder, right? This U.S. person that launched the foreign corporate entity. So what we're going to do is we're going to address two big issues, and that's U.S. trade or business risks for a foreign company. And then we're also going to cover the controlled foreign corporation rules for foreign entities. So if we're starting at the top here, and again, I just have one slide, so I've got it all summarized here in front of us. If you're an entrepreneur in the U.S., you generally create an entity in your home state. So if you're living in Florida, you create a Florida entity. If you're in Georgia, maybe use a Georgia entity. In some cases, you might go with an entity outside your state, so Delaware, Wyoming. Some of those states are preferable because they provide a little more asset protection, a little more anonymity, privacy protections than some other states. But in some cases, it might make sense to go completely offshore, right? So you're setting up an entity that's not even in the U.S. If you decide to go offshore, there's some very, very specific international tax rules they need to be mindful of. And failure to follow these rules can result in some pretty hefty penalties. So it's very important that if you do set up non-U.S. entities, you're mindful of these rules and these risks. So the first thing we want to talk about is U.S. trade or business risks for a foreign corporate entity. So when a foreign corporation, so let's back up. So a foreign corporate entity generally doesn't have to do anything in the U.S. It doesn't pay any U.S. taxes. It doesn't have any U.S. tax filings unless the foreign corporate entity is engaged in U.S. trade or business and it generates U.S. source income that is effectively connected with that U.S. trade or business. If a foreign corporation finds itself in that position, it's going to have to file a tax return in the U.S. and pay corporate income taxes. So why is that rule in place? Well, that rule is in place because if it wasn't, then every U.S. company would never launch a Delaware corporate entity ever again, right? I mean, think about it. If you had an office in, let's say, Maryland, and you decided, well, instead of opening a Delaware entity where I'm going to have to file a Form 1120 and pay taxes, the federal corporate tax rate, what if I just go offshore, right? What if I set up a tax-free entity in Bermuda or Cayman, I run all my business through there, I can get away with not paying any federal taxes. Well, not so fast, right? These rules are in place to prevent you from doing that. If a foreign corporation is engaged in U.S. trade or business and has U.S. source income, it's going to be paying taxes just like a regular domestic entity. And so in that context, the foreign corporation would be filing, instead of a Form 1120, it would be filing a Form 1120F, a foreign corporate tax return, and it pays taxes at the same graduated rate. So if we look at an example here where we have John. John's a U.S. citizen. He lives full-time in Miami. He decides to form a Cayman Islands company because he thinks this provides more asset protection than Delaware. And that's a fair statement. In a lot of cases, it does. John's going to own 100% of the company, so he's the sole shareholder. And he's going to operate the company exclusively from Miami. So there's no Cayman Islands office. There might be a mailing address for bank statements. But he's not going to travel there. He's not going to have any employees there. He's doing everything from Florida. In this case, because of John's presence in Florida, he's created a fixed place of business or a head office in Florida. That head office is what trips over this U.S. trade or business issue. So now we have a foreign corporation that is operating a U.S. trade or business, and the income that's being generated is going to be effectively connected with that U.S. trade or business. And so that's why the foreign corporate entity, even though it's in Cayman, is going to have to file a tax return in the U.S. and pay taxes, pay U.S. federal corporate income taxes, even though it's a non-U.S. entity, right? So again, just to recap here, as I summarized, because John is living and working for a foreign company from Florida, so he's created a fixed place of business within the U.S., his presence creates this U.S. trade or business risk, and the income that's going to be generated through that company is going to be effectively connected with that U.S. trade or business. So his Cayman Islands entity has got to file a tax return and pay taxes. So what does the Cayman Islands company need to do? Well, in order for any company to file a tax return, it needs an EIN. right? So even if it's a foreign company. So the Cayman Islands is first going to have to apply for and obtain an EIN. And once that's obtained, it can then file a Form 1120-F tax return. It reports its gross revenue that's effectively connected. It reports the expenses that are attached to it. And whatever the net income is subject to federal corporate income taxes. The other nuance with a foreign corporate entity is the branch profits tax, or BPT. So branch profits tax is an additional tax on what is considered a deemed dividend distribution. So with foreign corporations, anytime they have what's calculated as a reduction in net equity or net U.S. equity, there's BPT that potentially applies. Okay, so that's the other thing to keep in mind here. So that covers that section on the U.S. trader business risks and the 1120-F filings for the Cayman Islands entity itself. Now let's talk about the CFC rules. So what's a CFC? A CFC is a foreign corporation, right, where more than 50% of the corporate stock is owned by U.S. shareholders. A U.S. shareholder is any person, so this is an individual or an entity, a domestic partnership, domestic corp, etc., who holds 10% or more of the voter value in the foreign company. So in our example above, John's a U.S. person because he's a U.S. citizen. He owns 100% of the foreign corp. So the foreign corp is a CFC for federal tax purposes. Now, when you have a CFC, each shareholder must report their ownership on a Form 5471, which is included with their federal tax return. So when John files his Form 1040, he needs to include a 5471 with all the other schedules and attachments that are necessary, giving his category of filer, and that has to go along with his 1040. Now, what's unique here is that when you have a situation where a CFC is also created a U.S. trader business and has ECI, on the Form 5471, any income that was treated as ECI and subject to tax is going to be PTI, or previously taxed income. So if John had what would otherwise be considered Subpart F or a guilty inclusion, where he had to have income effectively passed through to him, he can reduce that inclusion to the extent that he's already recognized the income and had it subject to tax as ECI on the Form 1120-F. So that little last part there, I'm just touching on that high level. That can be much more complicated and it's beyond the scope of this video. I'll have another video that addresses that. But yeah, that's just something to keep in mind. When you have this situation where you have an 1120-F filer, but it's also a CFC, the shareholders need to be mindful of to what extent the income was already subject to U.S. tax, because that relieves them of having to include the same income as sub F or guilty. Very, very important to remember. So that, okay, so that covers all the pieces I wanted to address here. Again, it's just kind of high level, what you need to be mindful of if you go offshore. This can get very complicated, so make sure that you consult with somebody that specializes in this area to make sure that you're getting all the filings right. Because again, if you miss something, the penalties can be huge too. So thank you for sticking through to the end and watching the video for me. I hope you learned a lot. If you have any questions, please leave me a comment below. Happy to answer whatever I can. And of course, like always, I look forward to seeing you on the next video. Thank you.